So we're working through the events that were this week. Obviously, primarily of those was the presidential election and also the election for all of the members of the House and a third of the members of the U.S. Senate. Talked a lot about that before the break in terms of the implications. Obviously, you would expect to see some movement on taxes, income tax rates, estate tax rates, a decrease in student loan forgiveness, an increase in child tax credits. Those would be kind of some of the central themes that you would expect to see play out here over the next couple of years. In addition to that, of course, there was the Fed meeting this past week as well. And on Thursday, the Federal Reserve met and I guess here's the key. And if you're a regular listener to the program, you know we've said this before. You know, the unelected body, because you didn't elect Jerome Powell as chair of the Federal Reserve, that unelected group of folks probably has more direct influence on the economy than what you went to the polls for on Tuesday. So on Thursday, the Federal Reserve proceeded to lower rates by another 0.25%, that coming on heels of a 0.5% reduction back in September. It was a unanimous decision. So at this point, no cracks in the Federal Reserve's approach or direction in terms of interest rates. I'm not sure that necessarily moved a whole lot. If you look at the data on mortgage rates from the week prior, average mortgage rate in America had trickled down to about 6.1. This past week it actually jumped up to 6.8%. A lot of it is some concern over deficit spending and having that continue. We do have a problem in this country. It is called our deficit. Nobody wants to talk about it. But the bond market doesn't really care whether you want to talk about it or not. It is pricing accordingly. So one of the things that you saw happen was that bond prices went down, and that would reflect the fact of if there's more debt outstanding, more bonds to be issued, then the bonds aren't going to be worth as much. On the flip side, if you're familiar with how bonds work, it's sort of that inverse relationship. When the price goes down, the yield goes up. So mortgage rates, for example, jumped from 6.1 on average to 6.8 just in that 2-week period of time. So the bond market clearly is focusing on the debt and the deficit, particularly as it reacted to what was going on in terms of the other headlines this past week. The Federal Reserve lowering interest rates didn't necessarily move that needle a whole lot one way or the other. And as you said on the program, sort of minimal impact on sort of the average American. The average American, the outstanding mortgage right now is sitting at a rate of about 3.9%. So that's an American consumer that isn't as troubled by the current mortgage rate environment simply because they're sitting at 3.9%. What it does do is, as the Fed does cut interest rates, it lowers the rate that you're getting on your cash savings, your money market accounts, savings accounts, those types of things. So in essence, that continuing trend of lowering the interest rate is going to force many folks to sort of have to look at other options, maybe even investing that money. So that was the big headline number two. There was a third headline that actually just happened on Friday as well. Before we get to that, though, we want to welcome in all of our listening audience to Dollars and Cents. This is the show where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, also a top 25 financial planning podcast. Make sure you check out our website, nelsonfinancialplanning.com. There, you can schedule an absolutely free conversation, and we do not have account minimums. Why, you may ask? Well, because we're here to help, and we want to help you no matter where you are on your financial journey. I know many other firms say, you got to have $500,000, you got to have $1 million to come in and talk to us. I don't know how that could be considered being a fiduciary for the investing public, if that's really kind of the lines that you're drawing in the sand. I would submit that someone with $10,000 probably needs a little bit more financial help than somebody with $10 million, right? Don't you think? Anyway, my name, of course, is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great folks who also happen to be certified financial fiduciaries, standing ready and able to help you improve your life with a successful and cost-effective financial plan. So, I mean, the headlines alone, I mean, as you might well expect, right? It was an election week. But beyond the election, you had a Federal Reserve meeting where they cut rates by another quarter point on Thursday. And then on Friday, you may not have seen this story, but 2 of the 30 components that make up the Dow Jones Industrial Average change. So what that means is that when you look at the Dow, or that Dow Jones Industrial Average number, what you're looking at is a price-weighted average of the 30 different companies that make up the Dow. So in contrast to, say, the S&P 500, which is market cap weighted, the bigger the company is, then the more it drives the performance of the index. For the Dow, it is based on more about price per share of that individual company that helps to drive up what's going on in terms of that average. So as is usually the case, every few years you'll see some companies getting dropped, other companies coming in. Usually that's because of bellwether companies, because the Dow is generally thought of as 30 kind of, bellwether names, if you will, in terms of the types of 30 companies that make up the Dow. 30 of the largest blue chip companies, I guess would be the other way to sort of describe it in terms of those companies that make up the Dow. Well, as those companies see their fortunes, kind of ebb and flow, then what the folks at Dow Jones Industrial does is that they swap out different companies if performance is lagging or things like that. So NVIDIA, so on Friday in the Dow Jones Industrial Average, you had 2 of the 30 companies sort of get swapped around. NVIDIA, which is now going to be part of the Dow, replaced Intel, which is interesting because Intel sort of is a company that was a well-regarded company, but sort of missed out on all this AI stuff. And so that has hurt its performance. And so NVIDIA is getting swapped out, or Intel is out, NVIDIA is in. Similarly, Dow, which was a component of the Dow Jones, Dow, the chemical company, a much smaller company due to a variety of spinoffs that they have done over the past few years. So replaced by Sherwin-Williams, a 158-year-old company. Yes, that's who is on your paint can. They make paint along with various coatings and whatnot, all in sort of that chemical-y type of industry. But the Dow replaced by Sherwin-Williams as well. NVIDIA would rank 22nd in terms of price weighting out of 30, whereby Intel was last. What's interesting about this historically is if you look at this, companies that enter, their performance sort of drags going forward, because to enter the Dow, you had to have had a pretty good performance over the course of the past few years to grow to the point where you would be considered to be included in the Dow. And then on the flip side, if you're an existing component of the Dow and you sort of get kicked out, chances are, you might have fallen into some tougher times, rougher days from a business perspective that led you to getting kicked out, because the inclusion or the exclusion of a particular company in the Dow is sort of a rear view exercise, right? So if I'm Intel or if I'm Dow and things haven't been going well, then okay, you're out the door. If I'm NVIDIA or Sherwin-Williams, okay, things have been going well, so you can come in and replace these. But what happens is generally the ones that get kicked out wound up kind of having an improvement, and the ones that get put in wound up having slower growth. There's a bunch of studies on that. So, but anyway, obviously a significant week beyond 2 of the 30 components of the Dow being swapped on Friday. Thursday, Federal Reserve changing rates, lowering rates, and then, of course, Tuesday, the election. Let's hope next week we can all kind of catch our breath a little bit after this past week. We're going to continue here on Dollars and Cents with Joel Garris of Nelson Financial Planning.